Welcome to 77 Paisa channel. Please see the channel description to know more about this channel and myself. Today I'm going to discuss a very small topic about term life insurance. I'm a big proponent of term life insurance and been advising quite a lot of my friends to buy term insurance instead of buying the traditional endowment policies. And recently, one of my friends came back and told me that I've been trying to buy this policy online, but the insurer is giving me like two, three choices of premium payment plans. I don't know which one to pick. So here is a quick and easy way to figure out which is the best plan for you. Let me try to explain this using a real-time example. Here the applicant's age is 47, trying to get a 20-year term 1.25 crore policy. Look at the right-hand side. There are two options given. The regular pay option is you pay 26,860 rupees for 20 years. Each year you pay 26,860. Other option is each year you pay 78,922 for 5 years. So now my friend doesn't know which one to pick. So he went to some other insurance company, tried to get a quote, and this is what he got from the other company. This is a policy for 21 years. Sum insured is 1 crore. And the first option is if you pay like 36,226 for 13 years. And the second option is you can pay 25,134 for 23 years. And here they say that the 13-year option, you make a saving of 23%. Is really confused, and do you think that it is really a 23% saving? Let's go and check it out. Okay, let's first take a quick look at how this 23% savings came from. I made the simple premium table, self-explanatory. Last row has got the total payment and the plan 1 and plan 2. The difference between that is 1,22,590, which is 23% of plan 1. That is how they claim that you make a saving of 23%. On the first look at this, you can easily figure out that there is something fishy in this calculation, because you know that for the first 5 years, each year I'm paying 53,000 rupees more premium in the plan 2. So if I pick the plan 1 and use that 53,000, put that money in FD, that is going to earn me some interest, and it is also going to get compounded throughout that first 5 year period. So where is that taken into account? Looks like it has not been taken into account. So you know that, okay, there is something fishy in this calculation, this is not correct, but you do not know how would I compare these two cash flows and figure out which is the best one. That is what is explained in the next section. We are going to use a concept called present value of future cash flows to decide this one. Here is a dictionary definition, and you don't need to get into the intricacies of this definition. Simply put, what we are trying to do is we are trying to calculate today's value of future cash flow. That cash flow might be incoming or outgoing. In our case, premium payments, it's all outgoing. So we will try and find out in future there is going to be some outgo of cash, and what is the value of it today. So I do that for both the plans, and whichever plan gives me the lower value today, it is better for me because it means that I'm spending less. And Excel, MS Excel has got this inbuilt formula. If you're not familiar with Excel, you can go to Google and search for PV calculators, and it's going to throw up a lot of search results, and you can use one of that. I'm using the same table. I have added 4 columns to explain 4 different scenarios. Let's take the first scenario. You look at the table at the left hand side bottom. The first scenario is where you have been presented with these two plans, and you're already paying a vehicle loan or a personal loan for which you are paying 13% interest. If you are doing that one, definitely plan 2 is not going to be of help for you. You should go with plan 1, and whatever savings of 52,000, you should try and pre-close the vehicle loan or the personal loan. That is always going to be better. No need to even double check on this calculator. But if you don't have any loans, all I'm going to do is I'm going to keep that money in my bank account, either in my checking, either in my savings account or in my fixed deposit, or I might invest it somewhere else. If that is the case, then you should use this formula to compare. So first case I have taken, the second scenario that I have taken is you are keeping your money in savings bank that gives you 3.5% interest, which means that post tax you are getting 2.5. Always use the post tax rate of return, which means that you are getting 2.45% return rate of return. So if you apply the 2.45% rate of return for plan 1, the outgo value is 4,20,700. Even though you are paying 5,37,000 in the future, its today's value is counted as 4,20,700 rupees. And if you apply the same rate for plan 2, it tells me that its today's value is 3,67,000 only, which means that it is better to go with plan 2. If you are going to keep your money in a SB account, then don't keep it there. Pay off the premium. Second one is, what if I'm going to put it in a FD that is going to give me 6.5%, which is kind of post tax, it is giving me 4.37%. Use the same formula where you see the rate in the formula, replace the 2.45 with 4.375, and the value that you got for plan 1 and plan 2 is 3,57,000 and 3,47,000. Not a big difference. Still, the plan 2 is better, so you can go and pay off the plan 2. But if you think that I'm not going to keep it in a savings bank or an AFD, I'm going to put it in a SIP, or I'm going to put somewhere else, and I'm going to get like post tax returns of 12%. If that is what you think, then you should apply 12% in the formula for rate. And once you apply 12%, what you see is the present value of plan 1 is much lesser than the present value of plan 2. What it means is, if you can make 12% interest, if you can make 12% returns from any investment, it is better to go with plan 1 than plan 2. This is a very simple way. This formula is very easy to execute in Excel. The online calculators are also very easy to use. And there is also one more thing. In case of a loss event happens, in case of the death of the policyholder, what happens is, let's take the same scenario. If the policyholder dies in, like, let's say year 5 or year 10, as per the first plan, the total outgo from him is only the first 10 years premium. Whereas in case of plan 2, he would have paid out the complete premium, which once again tells you that the plan 1 is better than the plan 2. Use these two things to decide which is a better plan for you. And by the way, present value as a concept will find quite a lot of applications, not just the term life premium plan determination. Use it wisely, use it appropriately. Thanks for watching and happy investing. If you found this video informative, please like this video, share it, and subscribe to my channel. If you have any feedback, questions, or comments, please use the comment section and we'll respond as soon as possible. Thanks and bye bye.